Good morning to the lecturer and my fellow classmates. Today we will present our group assignment about performing financial and ratio analysis of two companies from the same industry. And the two companies that we have chosen for this assignment is Sunway Construction Group Berhad and Gamuda Berhad from the construction industry. My name is Divya. Together with me is KEAN, KAORI, and HAFIZ. We are from Group 7. So this is the overview of our presentation for today. We will start with the introduction, followed with brief description of the two companies that we will discuss. Then we will discuss on the different types of ratio analysis performed for the two companies. Lastly, we will conclude and give recommendation based on our analysis. Next. Okay, now I will give brief introduction about the construction industry where it is an important economic sector of a country. In recent years, construction sector in Malaysia has expanded tremendously, and as based on the an article, it was mentioned that the growth rate of construction sector in Malaysia is expected to reach 4.5% within the period of 2022 until 2024. Hence, financial statement analysis is done using companies' annual reports by examining the critical financial ratios and performing comparison with other companies in the same industry. This is important to improve and evaluate companies' performance. The different financial ratio analysis indicates how the company accomplished in respective departments and helps predict the expected future outcome using past and present performance. Now, I will pass to my groupmate to give short description of the two companies.
So, hi, Doctor. I'm KAORI. So, I'm going to talk a little bit about the description of the both companies. So, the first one will be the Sunway Constructions. So, Sunway Construction is one of the Malaysian's leading construction and civil engineering services firms. So, they have been providing quality constructions and engineering services for more than 40 years. So, with the total asset of 1,864 million in 2021, they're basically committed to delivering their clients the highest standard of safety, quality, efficiency, and sustainability. Next slide. So the next one will be the Gamuda. So Gamuda had been established in 1976, which is more older than the Sunway Constructions. So Gamuda is one of the largest engineering, property, and infrastructure companies in Malaysia. So with a total asset value of 10,863 million in 2021, Gamuda can basically undertake a wide range of projects, both domestically and overseas, including the MRT lines, highways, runways, railways, infrastructure, congestions, and any development of new townships. So that's a little bit about the company's description. So I'm going to pass back to Divya for the financial ratio analysis.
So now moving on to the ratio analysis, I will first present on the liquidity ratio. Liquidity ratio measures how quickly the company can convert the assets and use to pay off its short-term obligations. Current ratio is under liquidity ratio and it measures the ability of a firm to settle its short-term loans and payables within 1 year with its total current assets. We have performed and calculated the current ratio for both companies as shown in the table here. From the data, next slide. So from the data, we generated the graph and it shows that Sunway Construction had a steady financial ratio status from 2017 until 2019, but faced financial difficulties in 2020 and 2021 as they recorded low current ratio. As for Gamuda, it shows a fluctuating trend indicating that they had sufficient liquidity to pay its short-term loans throughout the 5 years. Next slide. So the next liquidity ratio is quick ratio. Quick ratio determines the company's ability to pay its current liabilities with its most liquid assets, excluding the inventory. So we calculated based on the formula and obtained the data as shown in the table for both companies. Next slide. Then after generating the graph, it shows that both companies have a steady quick ratio, but in comparison, Gamuda did better than Sunway by having ratio of 2 and more. Hence, both companies had enough liquidity to settle their immediate obligation and sustain their operation throughout the 5 years. Next slide. After liquidity ratio, we have activity ratio that shows how productive a company is using its assets to produce revenue. Asset turnover ratio is one of the activity ratios, and it shows the efficiency of a company using the assets to make sales. And the ratio is interpreted based on the industry. We obtain the data for both companies as shown in the table by performing the calculation using the formula and generated the graph. Next one. So based on the graph, it is known that Gamuda has been operating more efficiently compared to Sunway Construction throughout the 5 years, and it shows how Gamuda has been productively using its assets to generate sales. Now I will pass to KAORI for the debt ratio.
Thank you, Divya. So I'm going to talk about the company debt ratio. So debt ratio is basically a metric that measure a company's total debts as a percentage of its total asset. So from the table here, both company total asset and liability show fluctuated from decrease to decrease and back to increase throughout the years. Next slide. So here's the percentage of the both company debt ratio from 2017 to 2021, which reported to be considerably a high debt ratio, especially for Sunway Construction, with more than 60% throughout the following years. So from here that we can know that both companies' debt ratio are more than 30%, which indicated that quite risky and may lead to a discouraging on investment. Next slide. So the next one, I will talk about the time interest earn ratio. So this basically to measure the ability of a firm to cover its interest expenses out of its operating income. So from the table here, we can see that both company earning before interest and taxes are more than their interest charge. So it's indicated that, next slide. So it's indicated that both companies able to meet its interest obligations because earnings are significantly greater than their annual interest obligations. So in which the highest is from the Sunway Constructions in 2019, where they can pay off their interest of 5.82 times over, as for Gamuda only for 4.48. But overall, both companies have a interest ratio, the market ratio.
Okay, so good morning, doctor. I'm Kenwa. So now I'm going to talk about the market ratio. So market ratio assess the current price, the current share price of company stock, and this ratio are used by the current or the potential investor to find out that whether the share of the company are overpriced or underpriced. So inside the market ratio, we will have a price to earning ratio. So what is price to earning ratio? This ratio basically calculate how much do an investor can expect to invest in a company to receive $1 earning from that company. So this ratio also referred as price multiple because it shows how much investors are willing to pay per dollar of earning. So how to calculate this price to earning ratio? We'll be using market price share per common stock to divide by the earning per share. So in this two table, we can see the market price share and earning per share for both company. So in this graph, from the graph, we can earning ratio because both ratios exceeded 3, and throughout the 5 years, there is a fluctuation price to earning ratios, and both companies shows 2017 to year 2019. Both of the company also reached their highest PE ratio in 2020, which is for Sunway Construction, it's 44.5%, and Gamuda is 23.53%. In this ratio, we can conclude that Sunway Constructions has been preferable in the market throughout the last 5 years period. So next slide, please. Another ratio in market ratio is another ratio in market ratio is market to book ratio. So how to calculate this market to book ratio? This ratio is to value a company by compare the book value per stock, common stock, with the market price per common stock. So we can get the market price share in the financial report, but for the book value share, we cannot find it from the financial report and the balance sheet. So how do we get the book value per share to calculate the market to book ratio? So first, we need to find out the total asset and the total liabilities. We'll be using the total asset to minus the total liability, and we will divide it by outstanding common share. So after we find out the book value, then we can calculate the market to book ratio. So in the table, you can see both company market price share and also the book value. Next slide, please. So from the market share and the book value, we can calculate out the market to book ratio, and we can conclude that Gamuda has a normal market to book ratio because the ratio value is less than 3. But for Sunway Construction, it is not that stable because it has an unstable increase and decrease for both market price and also book value throughout the 5 years, which caused Sunway Construction to have a not stable and abnormal market to book ratio. That's all from me now. Hafiz is going to present profitability ratio.
Thank you, Kinwa. So I'll continue with the profitability ratio. So in this profitability ratio, we'll be see about the profit margin. So how do we get the profit margin? The net income over the revenues for both of the companies. And in the table, it shows that all of the net income and revenues for Sunway Construction and Gamuda. And as you can see from the graph shown, it shows that the Gamuda has a very high profit margin, but in 2019, for both companies, it decreased, and back to 2021, both of the company increased as well. So next one is the return to asset. So for the return to asset, it is measured by the net income over the average total asset. So it is shown for the both of the company in the table. So as you can see, both of the company basically have a very stable return of the asset, as is shown in the graph. And the next one we see on the return on equity. So return of equity is calculated by dividing the net income by the shareholder equity. So the return on equity will be considered as a net asset return for the company. So the net income and the shareholder equities are shown in the table for both of the company. And as you can see, in the graph, it shows that both of the company have the return on equity. So the Gamuda has a better ability to generate income from the shareholder investment compared to Sunway Construction. So both of the company ROE decreased in 2020 and it will increase back in 2021 after the COVID-19. So as a conclusion, both of the companies are able to generate prosperous profit from the construction sector during the COVID-19 years. Gamuda is one of the government's main contractors in developing countries' facilities So it has a better financial performance, and Sunway Construction is more focused on the developing private construction, whereas it is very hard to compete with Gamuda. But however, it still has a huge potential to grow in the market. Next, I will pass to Kinwa.
Okay, so so next slide, please. Yeah. Okay, so now I'm going to talk about the recommendations for both company after we analyze the financial reports in the past 5 years. So the financial analysis report shows that the constructions company must be able to face the uncertain economy conditions in the future, for example, year 2022 and 2023, because the economy is growing rapidly, growing very fast during post-COVID-19 pandemic. So besides, with the new government that formed in November 2022, it could be a new opportunity or also threat for both companies to expand their business, because we have a new government and there might be some new policies implemented in the construction sector. So now we conclude some recommendations for both companies. So for Sunway Constructions Group Berhad, the recommendations that we suggest is to proceed with the business expansions and also encourage the diversifications in their business. So Sunway Construction Group, they are more focused in the private sector. So we suggest that Sunway Construction should take more initiative on expanding their business into public infrastructure and also some facilities of the country. Besides, it may also consider to cooperate with the new government in tendering new government project to increase their competitiveness and also their profit. While for Gamuda Berhad, the suggestions that we suggested is to proceed with the sales of highway concessionary. So Gamuda Berhad should maintain their strength as a long-term partner with Malaysian government, because it is one of the most important developers for the government to develop the country infrastructure and also the facility. So besides, Gamuda should work closely with the new government in negotiating it for the sales of its 4 major highway concessionaries to generate more profit. Once they sell the highway concessionaries to the government, they can get more profit and they can use the profit to pay on their debts and also invest in future projects such as the MRT line and also the Penang South Island project. So these are the recommendations that we suggested to both of the company. So that's all for our group. Thank you, Doctor, for your time.